Good morning, class. This is your instructor, Nitty, and today we are going to be talking a little about the accounting cycle in practical sense. So what we are going to be discussing today's learning objective is pertaining to accounting cycle, and the things that we consider foremost in accounting cycle is the recording. The recording of transactions in general journal. Okay. So how do you record? So first of all, we're going to be talking about the accounting equation. If any of you are a bit confused about the steps of accounting cycle, you can just visit my previous lecture. So now the accounting equation was assets is equal to liabilities plus owner's equity. Now this could be just equity because this could be or equity. Then the thing that you need to understand is that when I say owner's equity, this means you started a business, okay? So let's just say Mr. A started a business and he needed funds. So he had, let's say, $100,000 to start with. But then he needed more amount, right? So he decided that he is going to be, initiating this process of having public money or drawing some money from the banks. So if this amount was just being considered for deciding upon how much funds he could procure, then this would have been owner's equity, okay? Because then this would be the amount that he has. However, if he is taking along with his $100,000 funds from public, or he could be taking funds from the banks as known. In this case, he could probably procure more money or further funds, because just from $100,000 he could be starting a very small scale business, like maybe a fruit shop. But you need to really think about the kind of business that you want to do, and then the funds that are required would be worked out eventually. So that would be with the help of analysts, various people that are the project managers, and then they all combine together with the consideration of what could be more or most beneficial in this case. So when you have external funding source, it could be some friends of his that have given him some money, but then that wouldn't be a sufficient source. That would not be something sufficient, or nobody would be giving him $200,000. Maybe someone can give him $20, $30. So he may be needing $1 million. So in this case, he would be going to multiple sources, and then this would enhance his funding by maybe $1 million. So now, coupled with his own funds, this is going to be $1.1 million. Okay? So that means that once you have your own source of funding, this would be owner's equity, because now you are the owner of the business, and equity is basically the funds that you put into the business. So if it is owner's equity, it means owner's funds, right? But if I just say equity, it means that the source of funding was not just his own, but that it also had public or external sources of funding. So then the terminology would be just equity, okay? So then I would change this to equity. But for ease sake, you can simply write, you'll see that when you search it out, some equations would just have owner's equity. That is because they're trying to teach you something basic at this point, right? So, but generally, big businesses or the public limited or listed companies. So why I say listed and not limited is because all companies that are publicly listed in stock exchanges are not necessarily, or you can just simply say that all public limited companies are not listed in stock exchanges. It's not a two-way relationship, all right? So one thing is that public listed company is public limited, but this is not vice versa. All public limited companies cannot be publicly listed. Some could be nationalized and they are not listed. So companies are listed or unlisted, despite of the fact that they could be having public source of funding through taxes, right? So in this, at this stage, what I would advise is that you just consider that a company which has external source of funding other than the bank loans. It means that they could have external source of funding through public by issuing a piece of paper or having an electronic record of the person who has given them funds, and then they promise that you can always come back to our exchange for trading or exchanging your ownership status. So that now you want to sell your status, basically that you gave us $5,000. Now you can just worth of maybe funds through various shares, I would say, or papers, piece of papers that the company has given to the person, and they are now, since they are electronic, so he would just simply go to the exchange and say that I don't want to keep those. So you just give me my $5,000 and you can maybe transfer these to some other buyer. So now those $5,000 will be paid back to you, and this ownership will be transferred to some other person's name, right? So now then in this case, you can say this is a publicly listed company's shares, and there are many companies that are publicly listed, like our banks, like maybe Citicorp, then we have agricultural companies, there's Nestle, there's PepsiCo, if you consider like Forty Fertilizer, then Bestway Cement, and so on and so forth. So we can just have this as equity because the company can have various sources of funding. Do we have another mark? Yes. So now you can say that this company, I would just simply say that it is liabilities plus equity. Now there are debit and credit rules before we actually do or learn how to do the reporting. So this was accounting equation. And now we need to understand again that what is debited. Assets are debited. So you have to, at this stage, just remember. You just write this down and remember that assets are debited. Okay, they are debit in nature. This is credited. So initially you memorize things and then they would gradually start making sense to you. And equity is also credited. Because you have to balance, so the purpose of this accounting equation and reporting is that we need to balance out things. Why we do that? Because we need to document all the transactions, the comings and goings of funds, the cash inflows, cash outflows, meaning that when you spend cash on something, naturally this cash will go out. Similarly, when you get some money from somewhere, then cash is coming in. So this is cash inflow. So then assets. Now what are assets? We will do examples of this also from your chapter. And this is the book by William Haka, Bettner, Carcello. You can take any older edition if the newer ones are not available in the market, but I'm doing it from 19th edition. And I told you that this is the normal direction, that this is debited. This is credited, and the short form is CR, okay? CR. D, R. That means D is capital, C is capital, but R is small, and then there's a dot, right? But if you decrease the asset, now this is, in this case, there are two things. The direction, now I'm going to talk about the direction. So when the asset increases, if asset increases, it's debit. If asset decreases, it's credit. Right? I repeat, when asset increases, it is debited. But when asset is decreased or it decreases, it is credited. Similarly, when liabilities increase, it is credited. But when liabilities decrease, then it is debited. And how it does that, I'm just going to be giving you an example after a moment. Similarly, now we have equity. So now equity, when equity increases, it is credited. If it decreases, it is debited. Okay. All right, let me just recap. When assets increase, you debit them. When assets decrease, you credit them. Similarly, we have liabilities. When they increase, that's the normal direction, you credit them. But when liabilities decrease, you debit them. Similarly, equity, when it increases, it is credited, but when it decreases, it is debited. So that means when you are going in the reverse fashion, reverse flow, then you will change the signs. Just like in math, when you are going from left-hand side to the right-hand side. So let's just say this was left-hand side, and this is the right-hand side. So if you shift here, you change the sign to negative, right? So if this is this plus this, and this is A is equal to B plus C. So if A moves here, it's going to be minus A. And if B moves here, it's going to be minus B, okay? So that means you change direction. Similarly, in accounting, when you change directions, you don't just add negative signs to it. What you do, you just write that it's credited. You shift the placement, rather. So how come I do that? I hope that you have registered this, and I'm going to delete this now. Okay, one more thing before I move on to an example. There is also another side that, first of all, you should also understand that there are alternate names for the word equity. Okay? Equity is basically sort of like funding for the business, which could be owner's equity plus public funding, public plus external funding. This is also known as capital. Okay, it's not the capital city. This word capital that you just have to remember, okay? This capital is just like having funds. It's an alternate name. For starters, you just know that this is an alternate name for equity. This is capital. And it is credited if it is increasing. Now then, again, there is another thing which is expense. So now this is also debited. Again, you have to remember that when expenses increase, they're debited. When they decrease, you credit them. Similarly, we have income. And both these things should be on either side. X is equal to y in this case. There's no other thing, there's no third thing. So this is, again, income is credited when it increases and debited when it decreases. So if you remember these rules, I don't think that you should have a lot of problem. And you can always make notes, but when you're doing the questions as an analysis in statement form, you will have initially some confusion, but if you keep this in front of you, then you'll be able to tally. Then how you do that, right? It would be correct or incorrect, you can automatically spot that. So now I'm going to erase it. You can just simply see that this is expense. When it increases, it's debited. When it decreases, it is credited. Similarly, income, when it increases, it's credited. When it decreases, it is debited. Now, I have written basically that expense is equal to income. Why? Because we consider that expenses are usually consumed, sort of like assets. When they're consumed, they become or convert into expenses. Now, this might not make a lot of sense to you initially, but I gave you an example that when factory worker, okay, he drives his salary from, or the wages from the, the revenue that this company generates through this whole setup of factory and then manufacturing and selling of items that they make. So obviously now that plant has some, they have some equipment in it where they're manufacturing all this stuff like cars. You can take an example of Toyota. You can take an example of Mark. One of the makes has several brands that it's tuning. So one is maybe Mark X, the other is Toyota Altis. And then similarly we have Toyota's Honda City and Honda Civic. So in this case, the factory has to be very big, and the equipment and the plant, we usually use the word property, plant, and equipment for assets which are fixed. When I say fixed, it means that they are immobile. What they are is immovable or immobile. So now, pardon me if you feel that I'm a bit deviating, but I'll just come back right to the point and then you'll understand how I'm making the link. So I said that expenses, at the same time that I'm saying assets are increasing, so they're debited, I say that expenses are also increasing, so they would be then debited. Why I would say that, whereas expenses would cause the cash outflow, and they are temporary, where the assets are basically, long term and they're fixed. So the link is that the rule is that when assets usually get, somehow they undergo a process of wear and tear, just like you purchase a car, and it would undergo a process of wear and tear. And the accounting term for it is depreciation, okay? So for each sake, I say that assets are consumed at that point. Consumption, it means that they are not of the same efficiency that they were before. So that means that they are losing their value, their capacity, and their efficiency is going down by the passage of time. So in this case, we need to either repair them or replace them. But our accounting rules suggest that we need to replace the assets after a period of time. And for immovable assets like fixed property, plant, and equipment, which is in short written as PPE, we say that they could take maybe 25 years, sometimes 30 years, 20 years. It all depends upon the kind of equipment that you have, okay? The kind of property or factory that you have. So this is property, plant, and equipment. By plant, I mean factory. By plant, I mean factory. Okay. So if it gets damaged, if it needs repair of any source, then that repair would be an expense. Because now your asset has diminished in its value. So that either there's some compensation for that diminishing, or this has to be replaced. This asset has to be replaced. So then, whatever we spend on either replacing or repairing it comes under the header of expenses. And other than that, there are also other source of expenses, like maybe you need some stationery. You need to buy chairs, tables. You need to pay workers the salary, the wages, and they all either count as the cost of the product, or they are entered as expenses in an other statement, right? There's another statement which is being made, and we are going to be discussing it later. But for this time being, you need to understand that when your assets, when you buy some plant, property, equipment, car, land, or you have cash, Cash is also asset, but it's not movable asset, okay? So that means then we have current assets. Current assets, like cash. Like items that you manufacture are also known as inventory. Or you purchase items. So the purchases that will make purchases of items. All derivate this term items that we are going to be selling. All these are as current assets, and inventory is that inventory which is reported at the end of this year. Because I said that in accounting we talk about year-end reporting. So everything is basically year-end. So this is year-end reporting. Okay? So now, this year-end reporting is from January to December 31st, or from 1st July of one year to 30th June of the other year that comprises of 12 months. Now it is dependent upon the company that whether they want to keep from January to December or from 1st July to 30th June of next year as their financial year, accounting year, okay, and it's a bit different from the fiscal year, okay, so this is an economic term, don't confuse it. Now, remember that there's another term which is known as tax year. The time period within which you have to pay taxes is like, tax that you pay for anything that you buy or you earn. So now those are expenses. When your cash is going out and you receive immediate benefit of the item that you either bought or you spend the money to receive immediate benefit, like for example, the workers are working for you, you receive the benefit in the form of their services and you paid them the money, so that means that this was an expense. And from where did you derive the funding or obtain the funding to pay those workers? So I said that wages are expenses, salaries are more like it, because if it's factory wages, then they are not like typical expenses, they are just included in the cost of the product. So at this moment, just understand that some workers have to pay their salaries, and those salaries come under expenses, and you need to have some money with you, to, just like your mother would have some money to pay to the person who she has employed at home to work for her, like the employees that you pay the employees. So that, in that case, this would be an expense. But you need to have some source to pay those expenses, and that source would be income. And income has to be equal to expenses. And if there's a difference between them, that means that that would be extra additional earning. This is pi, which is profit. If you have a difference between, okay, so now, rather I would say that at this time, income are equal to expenses, okay? I don't want to go into profit because then we need to consider revenue. And income and revenue are again different concepts. They're just going to be, this is going to become more complicated. And it just stays, I just want to make it very simple that income is some money that you are left with after you pay the bills, like something which is not counted as expenses, like maybe you need to pay the wages, like I said. That would be included in the cost of the product. Some of the money that is left out of paying out for those things that are not considered expenses, this is known as income. Let me repeat. You have lots of money at the end of each period. That period could be quarter, monthly. Like I have salary, okay? That would be a gross salary. But then I am going to be making some expenses. But before that, I need to maybe invest somewhere, and I need to keep aside some money which I will not consider as expenses. Okay? So then that means that my total gross salary was something else, and my take-home salary was something else, okay? If I pay tax, then that would be expense. But if I keep aside some salary for the purpose of investing somewhere else, then that would not be an expense. So in that case, I need to find out, maybe I'm doing some business. So if I am doing some business, then I will be investing in that. So it does not mean that income is all you earn. Maybe you have more money, you are just left at the end with income to dispose of, when you actually incur expenses. This concept, again, will be clear to you once we make the statement. Initially, just know that income is what money you have for one accounting period after you have earned it, and you incur some expenses, and those have to be equal to each other. Left hand side will be equal to right hand side, and within one accounting period. So that means this will not last subsequent accounting periods. But asset lasts subsequent accounting period because it gives you benefit in future years, right? So, okay, so as we proceed, you will be able to understand. Now, again, we have a term which is known as revenue. Revenue is gross earnings of a company. Okay? They are gross earnings of a company, but the company as yet has not incurred any expenses. Out of that revenue, like the gross earnings, then we are going to be subtracting cost of the product, cost of product. So I say that PIA, Pakistan International Airlines, or American International Airlines, they could be Southwestern Airlines, right? We have Turkish Airlines or Emirates. They earn a revenue through selling tickets. And their source of funding is people buying those tickets and giving them money. So ticket sale is the source of revenue for a services sector. Similarly, when there is a factory like Pepsi Cola, Nestle, whatever inventory that they sell or the items they make, they sell that. Lay's would sell inventory in the form of potato chips. They would earn revenue because that is the total gross earning. Gross means total, without any deductions. Then you have cost of the product subtracted. Okay? And any direct expenses like wages of workers, lighting, heating expenses like of the factory, lighting, heating, and factory expenditures. These are considered as cost of the product. When you reduce them, then that you get some profit, which is known as gross profit. Just to give you a brief sense of what is income and what is revenue. So this is gross profit, and then you start subtracting indirect. These were like direct expenses, okay? I would just call them for each sake direct expense. And this would be indirect expenses, which are not a direct expense related with product. All those expenses that are related with product, it could have some indirect costs as well, but they are still related with the product. But indirect means that now it's out of the factory, maybe shipment costs, shipment or depreciation. At the moment, you can just simply say that it could be not factory depreciation, it could be depreciation of the premises which are not related with the manufacturing process. And there could be salaries of workers that are aside from those working in the factory, or aside from directly handling the product. So all these indirect expenses, when they are subtracted, and taxes and insurance expenses and depreciation, etc., then when you subtract those from gross profit, you end up with net income. Okay, so this is net income. Now you understand that when all expenses are taken out from the revenue, we arrive at the figure which is known as net income. So that means that we incur these expenses and we came with net income. And had we not incurred these expenses, we would still be at gross profit. So that means, in other words, that these expenses would help us come to terms with net income. We needed this much. We arrived at this figure because we incurred those expenses. Alright? So there's a difference between having, revenue as total money, just like you go home with your pocket money, this is the gross. But when you start making expenses like, playing video games, getting stationery, books, holding parties, going to the restaurant, doing expenses. So then you are left with some amount of money maybe you can save. So the expenses that you incur are usually consumed within that same period. And they are not the same as revenue. Okay, revenue is the gross, then you incur some expenses which are important, and then you come to terms with net income, which is what is left behind. And for companies, they have businesses where they have left behind money, and they want to maybe save that money to invest further in the business, or distribute that as profit amidst the owners in the form of funds. Okay, so now at this initial stage, you just need to understand the terminologies. What is revenue? What is income? What is equity? What is capital? What is debit? What is credit? Now let's just start with the examples in the book because time is running out. Okay, now let's just start with, you can look at the, this is the chapter 3rd, the accounting cycle. Okay, I'm just going to be rubbing the, this. Now if you look at this accounting cycle, we have a few examples. And this is economic events. So first of all, that telling you that we have PricewaterhouseCoopers. Now what is PricewaterhouseCoopers? It's like a firm that would oversee the activities, the financial activities of other companies and monitor them and see whether what they are doing with their books of accounts or their financial statements or the information which is stored in a book, in a record, that is basically known as the financial report. They want to oversee that all the information which is put or arranged in those reports, and that record is correct, accurate, to the best of their knowledge. As per the management's assertion, I would say the claim, that this information is correct, then they will just use your opinion. And this firm is basically also the firm of accountants, and they do audit. The term that I'm going to be using for overseeing or monitoring is auditing. And this is a Pricewaterhouse is a multinational professional services firm. And this is one of the big 4 auditing firms. And what they do is that they're going to oversee, and they also provide consultancy services, okay, for businesses. Now what they do is that they would capture the economic activities. Capturing the economic activities of PwC is a complex undertaking. Now what they're trying to say is that since it's a consultancy firm, if had it been manufacturing products, it would have been easier to capture its own performance. However, if it's a services sector industry, then it's a service sector company, then it becomes very difficult to, monitor its performance. However, the thing is that services businesses can have many sources of services like healthcare, education, fitness, and other businesses. So when you want to look at a services sector company, you can just look at the employees. The size of the firm is by how many partnerships it has in various countries, and you need to also see that it is efficient and effective. It's very important that the company's reputation, that the firm, in this case it's a firm. Why I say firm and not company? It's not like a public listed company, it's a firm. Its shares are not available as in with public listed companies. And why we use it is because we want to know that its performance is up to mark, it has credibility, and we have documentary evidence that its services are professional, ethical, honest, and effective. So if they capture economic events, then that means that we can rely on the information that is being given by them, right? So this is reliability. Similarly, we go for the next phase, the role of accounting records. I've already mentioned this. We need to keep track. There is efficiency, documentary evidence of the business activities, and accountability. Naturally, we need to know what's happening to the company's shares, what's happening to the company's progress, because we assume that the company is doing well if it is a public limited or public listed concern. Then I would like to give you an example of the ledger is basically a system of record. I've already discussed and introduced ledgers with you, that it's a separate record for each item. After we record in a general journal, then there's another record for each separate item in financial statements. It's known as a ledger account, and I'll show you what it is like. And why we keep a ledger account? Because we need to see whether that particular item, the financial statement item, decreased or increased, and what was the balance of account, so that we can make trial balance, okay? After ledger, we make trial balance. So now the use of account. So first of all, there's a type of account. A ledger is also known as a T account. It's called a T account because of its resemblance to the letter T. And there's a left or debit side, and there's a right or credit side. So like if I said, if I wanted to write it as an asset account, asset could be cash, it could be property, plant, equipment, it could be furniture, fixture, right? This would be written on the left side or the debit side. And on the right side would be if that asset reduced. But if it was some equity, then it would be on the right side, and if it decreased, then it would be on the left side, right? Now if you look at this, these are debit and credit entries. I've already discussed the debit and credit balances. I would just like to go with some detail. We've done the accounting equation. We have done the direction. You are to read this. Okay? And what we have done here, I'm just going to be explaining a bit later. Let's just go further to analysis. Now the journal. Okay. That's what I wanted basically. And after that, in the next class, hopefully we will be doing the numericals, which will be the questions and solutions or solving all those questions. For example, what is a general journal or the entry in that? So this is going to be a general journal. It's going to be like a record in a register, in a book. And this is the sort of, it's going to be a very long one, but for one entry, this is the way you usually have it, okay? Now, what they're saying is, let's read what they're trying to say. They say that there was some, I think the statement was way before. Okay. Let us examine the very first business transaction of overnight auto service. This is the company, Overnight Auto Service. And recall that on January 20th, 2021, okay, the McBride family invested 80,000. Okay, so they have maybe, done hodgepodge with the year. You could just consider it as 2020 at the moment, that they invested 80,000 in exchange for capital stock, or that this is equity, in other words, that they invested 80,000 in exchange for stock. What does this statement mean? In exchange for stock, it means that they obtained those $80,000 in exchange for issuing stocks, for issuing the promises, the verbal promise, not a written one, a verbal promise through issuing stocks. Those stocks are in electronic records rather than in hard form. Initially, they used to be in hard form, but now, with the advancement of technology, they are in electronic form. In softwares, there's a record of all the customers. Just like in bank, they don't give you some written piece of paper that you are account holder, but they would rather give you they have your information with them in their system, okay, that you are an account holder. So you fill out the form. Similarly, you open an account in a stock market, and that account would have some initial value of 1 lakh, 2 lakh, whatever, in rupees, or could be $1,000 for in dollars. So you have, maybe given them 80,000 in the sense that the company wanted money from the public, and you are the public, so you invested in stocks, and they wanted funds, so that was just a verbal affirmation. You got yourself enlisted in their record or their pool of customers, and this is exchange, that you got the ownership of a part of their business, and they got a part of your funds, right? Now thus the asset cash increased. Now you pay attention, this is going to be a similar statement structure that you're going to be given in the exams, or typical accounting statement like, you invest some money somewhere. That means when you invest, so if the company is investing somewhere, either it issued stock or it is buying stocks of some other company. If you are the buyer, your cash is going out. But for the company, or from the company's point of view, the cash is coming in. Understand? Because the company wants funds from you, and the cash is coming in, and you are giving out the cash. So from your point of view, or your perspective, the cash is going out, but the company is receiving the cash, so the asset is increasing by $80,000. So what are you going to do? You will debit cash, because now the asset is increasing. You will look at the accounting equation, and you will see when an asset is increasing, there's a debit. And if it is decreasing, there's a credit. So you are going to be crediting your account, but they would be debiting their account. And since we are doing the accounting from the perspective of the companies, so we are going to be debiting the asset, which is current asset, okay? This is the current asset, and this is cash, which is 80,000, and the owner's equity account. Capital stock is also increasing, so we are going to be crediting capital or equity. Capital / equity. So the statement, you can just look at the statement, it's like this. So as you see that the cash is increasing, okay, and the capital stock is also increasing. Now you can ask that they issued the stock, so then that should be decreasing, right? But no. The capital stock is issued, it's never decreasing. It means that you have given them your word that, okay, this is our company, we need funds from you, and we have put your name as our partial owner, as we've given a small portion of ownership to you, and as a proof of your investment. So then this is your stock. So the stocks are increasing as the ownerships are increasing. So when public ownerships increase, the stocks increase. So one, that capital stock increases, and if capital stock increases, then cash also increases. And they are unidirectional. It cannot be that stock is increasing and cash is decreasing. It's not possible unless the share price is negative. Like preferred price, they will be giving you in negative dollars that they would actually pay you to take it, So why would a company pay you something to, sell their stocks to you? They would only pay you the benefit of earnings that they make out of the funds that you have given them. Okay, the earnings are in the form of revenue and the income. So if they have any income left from the expenses, which is not possible in the initial stages of the business, but after 2-3 years, when companies start actually making profit, they would like to, give some benefit to their shareholders or their stockholders, and they give them some money. So this is capital stock. And then there's a small statement. So you record the transaction date, which could be 2020, and then owners invest cash in the business, and you could also place a bracket, right? So if you understand this initial phase, then others would also be easier for you to know. Let's just look at some other more examples. Okay, so they have also explained the general ledger to you at the same time, and I will also explain the ledger to you. Then we'll move on to the further examples quickly. Now, as you can see that cash is an asset, and ledger would have individual items of financial statements. You can see that cash increased 20th January or January 2020. Something you can just read as January 20th. So this is 20th January 2020. And at the same time, the capital stock increased, but now there are two different records for it. And there's a T account. When we talk about general ledger, we have a T account. There's a date, and there's an amount. If asset is increasing, you place it on the debit side. So you can just, for ease sake, write there's a debit and there's a credit side to it. If it reduces, it comes here. Now, when would it reduce? If you buy something. So for instance, if you buy a car, there's going to be another account, car account. You buy a car, and for maybe $10,000 or $15,000, so car worth of $15,000, you're going to be debiting on, maybe this was January, so you can just write 20th February. In this way, the car account would be debited. This was worth for. This was what the car was for, and that is $15,000. And in this case, cash would be reduced again on 20th February as $15,000. So the balance would be, after subtracting 65,000 remaining, right? Because you subtract 15 from 80, and you have 65,000 remaining. So then this balance would continue. Okay. So why we make ledgers? Because we need to know the balances of all the items. Now those items could be asset, they could be stock, it could be income, or it could be expenses. But this is just a general frame that you need to understand. Now we come to the second part of the analysis. Okay, there's another, okay, we have done this analysis. We just go back to the next analysis. This is the next analysis. Okay. Now the asset land is increased. Now again I said land is asset. If it is increased, it's going to be debited. And asset cash is decreased. As I told you, if you look at the accounting equation, when asset is reduced, it is credited. So when you credit something, you put an indent. You don't put it on the same level, okay? You don't write it just under the land. Under the land, under land. And you're going to write it with an indent. under land. So this is going to be this is like this. This is going to be left with a space. So now this is 52,000, and you can just debit credit rules is that increase are recorded by debits, so you debit land. Decrease in assets are recorded by credit, so you credit cash in this case. Because you reduced cash, and you can maybe place it here at the same level, or you can just place it here, okay? Because they did not occur on the same date, so you can maybe write it not just exactly at the same level. You can even write it a bit lower than that, or you can write it out because the credit side is completely empty, so you can start from here. It's up to you. Now we have land. That's all we have. So this is the T account. It's very simple. You just place the debit here and the credit. Once you make the general entry, then it's very convenient for you to write it or make a ledger. Then there are further varieties of ledgers. So there's running ledger or closed ledger, but we are going to be doing that later. At this point, the initial points just need to make yourself aware of what it's like and acquaint yourself with the terminologies. So there's another example. Okay, let's just look at this example, okay? And I want you to see all this and read this for next week, because all the questions, before I solve questions, I need you to go over this chapter 3 till 3-5 which is learning objective for journal entries and accounting equations, application with ledgers. A new asset building is acquired at a total cost of 36,000. Now you know that asset is acquired, asset increases, this will be debited. Building is acquired, building is debited. The asset cash is decreased. So when asset is decreased, one asset is increasing but the other asset is decreasing, so it's going to be credited. So you credit the cash. And okay, now I would also request you to make a dollar sign with this. I would really appreciate that. Okay? So, and liability notes payable. Okay, what's the notes payable? It's a written promise that I'm going to be paying you, Haka, would be paying you $3,000 after a span of 6 months with interest payment or without interest payment at the date so and so. The date could be 31st December 2020. And you can also change it a bit as Haka, received $3,000 on this date of, what's the date today? So it's 6th of October. So you can just simply say 6th October 2020, I received $3,000, so Haka, and would be paying you back this much, $3,300, along with including or inclusive of interest, $3,300 on 31st December 2020, or after a span of 6 months. It could be in March. So October, November, December, January, February, or it could be on the 1st of March, right? Because you include the entire month of February. Or it could be 6 months, right? So you can just write, this is just basically a promissory note that you're going to be paying back someone. So this is a liability. There's another note, which is note receivable. This is actually, company is receiving promise that it's going to receive that. So your note payable is a note receivable for the other person, okay? So like, this is my promise to you, my note's payable. But it's your note receivable because you're going to be receiving the money from me in the future. So it's a receivable, okay? Now increase in, so if there's a liability increase, the company's liability is increased because it's not paying the entire amount. It is paid some amount with cash and some is left. That means there's a liability which is created, and this is credited because liability, according to the accounting equation, when liability is increased, it is credited. So now you can make a T account for building, cash and notes payable. Remember, all items have separate T accounts. So this transaction took place, this is the date, This is the value of the building. Now again, you go to cash, date, initial cash 80,000. Then you purchased perhaps one asset, land, and then there's a building of 6,000. Because the building's worth is not 6,000, remember this. The building's worth is 36,000, but since the cash that was dispersed was 6,000, so you're strictly going to be mentioning that amount with which the asset was decreased. If this is the liability, then you can further have the notes payable. And I'm just going to show you the rest of the items here. As you can see, this accounting equation. So you have assets 36,000 and making a small down payment of the cash was reduced by 6,000. Liability was created and owner's equity. Right now we don't have owner's equity except for the stocks that we had. And that was not owner's equity. Okay, so we can leave this blank. Okay, so why I'm leaving this blank is because, like I said, stock was not owner's equity. Owner's equity is the fund that we place inside the business to run it. But the stocks were actually equity, part of the capital that we procured from the general public. So that's why it's blank. And you can do the other analysis portion, and I hope that you can understand this. And I want that you should do, this should be 97, do all these examples till basically, okay, now this is just a general picture of all the entries. This is the ledger showing transactions, sort of like a running ledger. Till the time the transactions are of the same period, like could be of a year, could be monthly, depends upon the practice of the company, whether they want to close the ledger every month, quarterly, semi-annually, or annually. So this is perhaps monthly, and then you can just simply see that they have individual transactions, and I would like that you do it to the page further. Let's see what's ahead. This is the common equation. I want you to read what is net income. There's a statement here that says that net income is an increase in owner's equity. Okay, so why do we say that net income increases owner's equity? Because net income is like profit that a shopkeeper could earn after, spending on the items that he bought. You go to a store, you go to, let's suppose, McDonald's, and they sell burgers, right? So they have inventory. Burger is their inventory that they're selling, the items that they sell. And so now, after paying the staff, for the electricity bills, the utilities, and catering for the depreciation expenses, and paying all the other salaries and wages, and looking after the repair and maintenance, and also the supervisory staff, and the taxes, they are left with net income. So now, when they sell the inventory that was burgers, you paid them some money, so out of that they did all those expenses, they incurred all those expenses, and they are left with some money which is their profit. So that profit is basically net income, and net income can be reinvested into the business to expand it. Like Bettner University is making an H11, there's another, there's an expansion of this university. They have had several campuses in Karachi and other places. Similarly, we can have a look at foreign universities, like Nottingham University, UK, and they have a campus in China, maybe. They have, some collaboration in China and some in Malaysia. So you have international campuses or whatever, then there's expansion going on, right? So this is basically owner's equity, because now they have earned something from the business. They have not acquired it from some bank, they have not acquired it from public, but they have generated it from what they were selling, and this is known as the increase in owner's equity, and this is also known as retained earning, because they retained it and they reinvested it into the business. Okay, the word is retained earning. At the moment, I want you to read the text. It's very crucial before the next lecture. And this is the examples. I want you to look at the retained earnings concept. What is dividend? Dividend is something that you pay the stockholders as prize money, because they gave you funds and they would like you to share a bit of their profit as a goodwill. Some companies give dividends, or not all. Like some very good companies don't give dividends, and I want you to see the matching principle. Expenditures, more than one accounting period, accrual based Okay, so this is something we're going to be doing a bit late. What is just for the moment you understand that cash basis is that you immediately receive cash for the items you're selling. But accrual means that there is either a note payable or a note receivable. So the person is not immediately paying you for the inventory, but rather he's going to be paying you later on. And I can give you an example of maybe, so this was, there's company Crema, or this could be, Almarai, there's an international brand. So some of these big firms, when they produce something in bulk, they distribute it to, wholesalers, and the wholesalers would not immediately pay them. So when they pay them later for the inventory that they receive today, that is known as accrual basis. It means on loan or credit basis, okay? So I want you to study this as well. And so this is page 105, okay? So just do this. And the last topic is, I think this was just cash flow versus income statement recognition. So this is till page 105. Start chapter 3 till 105, and that's about it. I'm done here with my lecture of today. And thank you so much, class. If you have any questions, you can just, put that on WhatsApp or in the comment section of YouTube. And this will be probably uploaded soon, in 3 to 4 days' time. And I appreciate your patience. And if you have any other further questions, you can always contact me. And we can also have a Q&A session later. Thank you so much.